operations at Onslow basically stopped. It looked to me like haulage wasn't going to work, and as a consequence there would be no transhipping. As a consequence there'd be no money, and as a consequence the bondholders were going to end up owning the company. Trav kicked off my Twitter career. I got like
and gave you the Moz name.
Yeah. I got 300 followers overnight, and then it was off to the horses.
You made it.
Well, Trav's made it. Trav's now.
Forget Oxford. You're all sorted.
Oh, mate, how funny is that clip though?
No matter who shares that video, no matter where they are, no matter whether it's Elon Musk, there's a great big Travis Ricardo bubble that links to your profile.
Yeah.
So Elon Musk is sending a tweet that has Travis Ricardo and a hyperlink to your profile on it.
That's pretty funny.
It's incredible.
It's kind of crazy. Yeah, I'm happy.
Daily Mail writing in for a comment. Yeah. That's pretty funny.
That's pretty funny, mate. I'm just happy.
That's the lowest form of journalism. Just like a Twitter event's unfolding, quick, stick it on the front page.
So you know what's kind of funny? Both Daily Mail and news.com.au picked it up. Daily Mail actually asked for a comment. To which I said the news.com.au article was pretty good. Just use that.
You don't know that guy though, do you? You just someone just sent you this? Or?
Yes. Yeah. I like, mate. Jerry is clearly like that. That
Salt of the
snippet
earth,
was worthy of being a viral clip.
Yep.
I'm happy to just milk it for the virality that it is, but I can take no credit for that at all, other than just reposting.
But did you post it intending it to go viral?
I had no idea.
Were you just like, this is gold?
I just thought it was sent to me on WhatsApp, and I looked at it and I showed it to JD. And
you both
people needed to see this.
When he started just cracking up in the same way, I was cracking up. I was like, "Is this on Twitter yet?" I checked Twitter, wasn't there. I'm like, "I'm putting this up." Like,
and 24 hours later, you've doubled your follow account. You've got 1 million views or 1 billion views or some insane number of views.
My new followers are going to be very disappointed when I start tweeting about
when it's hyper technical.
My new followers, they've all got like Australian flags.
I noticed. I noticed.
Very patriotic.
Put it this way: if I interview Pete Buttigieg, they are not the intended listeners to that conversation.
You just let me know if you want to reach them. I'll put out some tweets for you. Moz, thank you for coming in.
Thanks for having me.
Who are you?
Who am I? I am an erstwhile lawyer turned Twitter commentator.
And the reason that we're bringing you in for studio, mate, is it's kind of an interesting, a different kind of chat we're going to have, JD. But Moz has become obsessed with a single stock. That single stock just happens to be my favourite stock, Mineral Resources, and your obsession. I find interesting. I find interesting when anyone gets like solely obsessed.
We like obsessed people.
If you get so obsessed with like a single stock, I know it's the only stock in your portfolio, so it's like you're solely obsessed with this one stock. Then I think you have a tendency to do hardcore analysis. You try and check all of your assumptions. You see where you're right or where you're wrong. It doesn't mean you won't have biases along the way, but you've been putting your analysis out there into the abyss. It's gathered some attention. I've found it useful in checking my own priors, and I just think it's an interesting point in time for us to really peel apart where MinRes is at right now, like bullish thesis, bearish thesis, and the whole swarm of other affairs going on. We're recording this Monday afternoon, 28th of July. Their reporting is coming Wednesday. For the June quarter, stock is run from 14.40 up to it went up to like 34, and now it's back down to $30 today.
Yep.
I know your average entry was in the 20s, 22-ish. How the hell did you get obsessed with MinRes?
Well, it's an interesting story because this conversation could be unfolding in a very different manner. When I first started following the company carefully, it was because I thought it was going to zero. And I thought that this was a dead to rights story of corporate failure. This was in April this year. I've followed the company for quite a while. I've always been interested in its CEO and his business. It's hard not to be interested in someone like Chris Ellison, I think. especially when you live in WA and you grow up in a mining or mining adjacent sort of world. But in April, I thought, as I say, this company was going to zero. So I started doing my work, and that period of time coincided with Trump's doomsday tariffs. And whilst all of that was going on in the background, the Onslow iron ore project for MinRes wasn't having a great time. Perhaps it's useful actually for your audience if we go back in time a little bit and just set up what's happened with MinRes over the last 18 months. You've covered it pretty well. But 18 months ago, this company was moving from strength to strength. It had a supportive lithium price. Maybe 24 months ago, it had a supportive lithium price. It had an iron ore price that was maybe not irrationally high, but strong. And then over the next 6 months, just about everything went wrong in fairly catastrophic fashion. The lithium price collapsed, spod fell down to, at one point, 500 US on an SC6 basis. That was a month or two ago. And that alone, I think, would have been enough to cause some panic amongst the market for MinRes, or in respect of MinRes, particularly given its highly indebted balance sheet. Then things started going wrong on the iron ore side of the business, and the iron ore price weakened a little bit. The trucks started rolling over, and earlier this year, the haul road started to fall apart as a consequence of some wild weather up north. I think these three factors, each individually, would have caused jitters in the market. Together, they conspired to bring the company to its knees. And at the same time, there was a high-speed collision between Chris Ellison's personal life and the affairs of the company. And that I think was the straw that broke the camel's back in respect of the market's view as to the value of the company. Now, none of that fazed me a great deal, but then in April, operations at Onslow basically stopped. So I was interested in following what was happening on the shipping side of things, and I noticed that there was no shipping. For the first half of April this year, it looked to me like this company was going down. It looked to me like haulage wasn't going to work, and as a consequence, there would be no transhipping. As a consequence, there'd be no money, and as a consequence, the bondholders were going to end up owning the company. And that's where I fired up the account maybe a little bit after that and started giving my thoughts. Now, this long monologue has meant that I've somewhat lost your question, but you asked me what my interest in the company is, and my interest now is in looking at the fairly spectacular comeback that I think the Onslow Iron Ore project has made over the last 6 months, and particularly the last 3 months, following a period in April where, as I say, almost nothing was happening.
You were looking to see if you should put on a short.
Yeah,
and
yeah, exactly.
In your DD, you went to the transshipping volumes effectively. At what point were you tracking the volumes and you thought, hang on, maybe consensus doesn't quite match my view?
The first 3 weeks of April, they shipped almost no iron ore. And they didn't say anything. They didn't update the market as it was occurring, but it looked to me like they were on a pathway to be delivering 5 million, maybe 10 million tonnes on a per annum basis, unless things dramatically changed. So at that point, I thought, at that point, it's a matter of simple maths. There's no universe in which this company comes out of this without a massive cap raise or some sort of other fairly drastic liquidity change in the company's liquidity. And that's where a decision had to be made, and that was where I think the people who were short this company seemed like they'd been vindicated. That roughly corresponded with some of your work, Trev, and you were quite bearish on the company. And I think perhaps that bearishness stemmed from your view about the feasibility and the success of Onslow. Is that a fair comment?
I don't think I'll reveal if I've ever been bullish or bearish. I feel like my sentiment, might come out. I feel like I'll be scathing of capital allocation decisions. I'll be scathing of the level of reporting to the market under certain circumstances. That actually has improved, by the way. Obviously scathing of like corporate governance issues as they've transpired and evolved. I think there's like a lot that I have been and am willing to be complimentary to the business for as well. Like the degree to which MinRes has a culture of like making things happen in a very, very short time frame is generally unparalleled, amongst the sector. And I'm happy to say that. The balance sheet is everything, and then the cash flow from Onslow is everything to address that balance sheet. So I think the eyeballs have to be on the delivery of Onslow, because that's the only solution for the balance sheet. And in April, you're 100% right. Like, there was no indication that this project was going to be what had been put out there. Proof's still going to be in the pudding, but the volumes coming out of Onslow you've been tracking the last couple of months are certainly stronger than I was expecting.
Yeah, they have. They've been a lot stronger than I was expecting. On that point, I should probably just clarify before we get into some more of the detail what the purpose of the shipment tracking Twitter account is that I'm running, and also more importantly, where my data is coming from. Based upon the number of journalists in my DMs, I think there's a suspicion amongst some members of the market that I'm providing non-public information or information that the average person doesn't have access to. That's not right. Generally speaking, there's three sort of buckets of information that I draw from in respect of that account. And the first bucket is the majority of it, and that's information that is publicly available. So shipping information is publicly available. There's AIS tracking that anyone could get access to tomorrow. I also share information that comes from a more, I suppose, terrestrial source, but remains public information. So if somebody observes a particular event that's happening up north, that's not insider information, that's not non-public information. It's maybe a little bit harder to find, but I just want to make it very clear that I don't have any special access to any company information. I'm not an insider. I've never worked with MinRes in any capacity. I don't know anybody who works at MinRes, and none of my information is information that the average intelligent and well-meaning individual would struggle to find. That said, there are two other buckets which I think is useful to be able to draw from. The second one is just speculation. So I try to make this clear when I do this on the Twitter account, but some of what I say is speculation, is just a guess based upon the information that we have. And the third bucket of information is hearsay. So much the same way that you guys every now and then will report on something you've heard about, I do that occasionally on the Twitter account. It's not reliable in the sense that I have no way to know whether or not something I say is necessarily accurate, but I try to take whatever steps necessary to ensure that I'm not spreading nonsense. As I say, I think it's important to get that out there. I wouldn't want anybody making investment decisions based upon something I've said, assuming that I'm more informed than I actually am. The point of the account that I'm running is just to give your average investor more, I suppose, finely grained information about what's going on at the port. Because I think at the end of the day, despite the fact that this company trades like a lithium miner, today down 7% or whatever it closed at, along with PLS and IGO and the rest of the lithium miners, I think Onslow is really the key to this company's success. And I think that if Onslow were to go wrong, nothing else matters. I don't think the balance sheet can support. I don't think the balance sheet can be supported by its mining services business, no matter how outstanding that business may be. and it certainly can't be supported by the lithium business. Not at prevailing prices for lithium in any event. So I think our best guess as to where this company is going is what's happening at Onslow. Do you agree with that?
Yeah, and that balance sheet at last quarter, there's $5.4 billion net debt. If you're kind of trying to, you've got $500 million of interest payments that need to be serviced on the on the debt, and so you effectively need operations that can produce enough free cash flow to at a minimum service the interest payments on that debt. And the only way you can get there, in my view, is through the delivery of Onslow with margin.
Yeah, I agree. Before we get into what I think is happening with Onslow itself, perhaps we could just talk about a few themes that I've observed in respect of this company, because they make for fairly torturous. They make the lives of anybody interested in following this company as a hobby fairly torturous, to say nothing of those who have invested their own money in the company. As you mentioned, a category into which I've recently fallen. And something I thought we should spend some time talking about is the way this company talks to the market, because it has been in my view, a consistent failing of this company. And I should say that any criticism I have of the company is not criticism of individuals at the company. It's criticism of the company itself. I say that because it's true, and also because I know enough about Australian defamation laws to know that you can't defame a company.
So
as long as there's more than 10 employees.
Yeah. They haven't laid off enough to bring them under that number. What was that?
So you start following the company in April, and then obviously your work kind of goes back and you start to get a flavour of how they report. And
yeah, well, actually, April's a great. Starting in April provides a perfect example of the phenomenon that I'm about to describe. In April, as I say, not much was going on in terms of Onslow shipping. There was silence from the company. At the end of April, right before I was thinking, all right, time to go short, the company publishes its quarterly, and they have an interesting part in it where they talk about what's happening at Onslow in terms of haulage and therefore shipping. And they basically say, yeah, April was a terrible month, but don't worry, May and June are going to be much better.
We're going to double.
Yeah, we're going to double. In fact, they imply that in May, which was 3 days after this quarterly report came out, they were going to be hauling and shipping at a rate pretty much on nameplate capacity at 35 million tonnes per annum. And there's an interesting part of that quarterly report where they say that the reason April was so poor is because our contractor trucks that we're running while the haul road has been repaired are operating at a reduced cycle time. And the cycle time's about 2.9, they said, and we think it can be 4. We think we can get it up to 4. And they say in May and in June it'll be back up. It'll be up at 4, and that'll give us the haulage we need to operate at 35 million tonnes per annum. And they say in that quarterly, these projected cycle times are now being achieved. So we are presently at the end of April achieving a cycle time of 4 for these contractor trucks. Now we get into May, and for the first half of May, they're not shipping at anything like 35 million tonnes per annum. And I'm sounding the alarm on Twitter saying they are not going to meet this guidance. They're clearly down. They're not down by 5% or 10%. They're down by 50%. And then on the last day of May, or one of the last days of May, the company jumps in with a one-line announcement, price-sensitive announcement titled Onslow Iron Update.
The day before the site visit.
The day before the site visit. Yep. It's accompanied by the site visit presentation, which is a long document, not marked price-sensitive. But in addition, they jump in with this single-page document in which they say, yeah, we're way down on exports for May. We're not going to meet our guidance. This is because our cycle times are at 2.7 or 2.9 or some number in the 2s. So just stop and observe what's just occurred. They've said in April, we have our contracted trucks operating at a cycle time of 2.9. But they're now, at the end of April, operating at a cycle time of 4, which means in May, we're going to be exporting at 35 million tonnes per annum. Then at the end of May, they jump in and they say, no, we're way down on guidance. Our trucks are operating at a cycle time of 2.7, call it. I think it was 2.7. That sort of carelessness in the way you report to the market is destructive of the ability of your investors and your prospective investors to take you seriously. And it makes trying to build out an accurate valuation model for this company very, very difficult. I continue to be concerned that it's not possible to put faith in some of the things that this company says, be it through carelessness or be it through sheer happenstance. And this is a problem that I think has plagued MinRes for quite a while. I think this company suffers from a discounted valuation in the market. I think the market builds in a discount as a result of the complex vertically integrated structure with a fair bit of, if not obfuscation, at least a lack of clarity surrounding the company's operations. And it's frustrating because this can be fixed very, very easily. What do you think about that, Trev? Are we on the same page?
Oh, yeah. The company's got a history of minimal disclosure. I think it'd be the only company where I still to this day don't quite know what material, any materiality threshold is. That just seems like a subjective kind of term that could change. But there's a very kind of confidential materiality threshold for a lot of disclosure. I think there's been signs of improvement. Like, for example, the latest quarterly did have information relating to Onslow that was more thorough than there had ever been in the past.
Yeah.
The Onslow site visit presentation included a level of disclosure that had previously not been revealed on a lot of different parts of the road. It also included a minimum guarantee in relation to the whole road, which was a specific, a specifically asked question in the past, which was kind of sidestepped and had now been revealed. Those were positive steps in regards to the level of disclosure the market expects. And I think why is it important? Because if management at MinRes has a positive differentiated view on the stock versus what the market was pricing in, then why not give the market that information?
Exactly.
I'd push back on the notion that this is unique, though. I think this is super, super commonplace across the resource landscape. And there's plenty of companies. Fortescue is one that comes to mind, and they're always stretch targets that they're putting out there. Yep. And they're, look at Iron Bridge, for example, or you could go back 20 years and say the same thing about Fortescue. But that's part of the culture at the business.
Sure.
There's documents that are said to be binding agreements, and they're just not at all.
The degree of materiality that Onslow in particular has to this company, and the market's never seen a feasibility study from MinRes. It's never,
those examples would be Fortescue 20 years ago.
Yeah, and if you also just think one of many kind of reporting gripes that I have. One of them largely relates to, I don't think there's a single analyst in Australia that can really tell you the value of CSI. And undoubtedly, CSI's, the mining services businesses, contracts that they have with the majors are incredibly valuable, and they have tremendous earnings resilience. They have tremendous ability to roll over contracts repeatedly. There really isn't any other competition in that space, the contracts they have with the majors. However, my gripe is that the volumes attributed to those contracts with the majors are grouped in with volumes
servicing their own mines.
The servicing MinRes' own JV mines, and which are, in my view, they're cyclical operations that are vulnerable to being turned off in a down market. Whereas the way that the mining services contracts are portrayed to the market in general are like these infrastructure assets that the cash flows go on forever and ever. And to kind of hone in on why I underline that, it's the last quarterly you actually saw the way that earnings to the CSI business can be hit when when there's this over reliance on third party trucking and haulage at Onslow. Like that's at the detriment to the earnings of CSI business. So all of that to say, no one can actually disaggregate the value of CSI business if they don't know the disaggregation of contracts to MinRes' own mines and what they look like versus third parties.
And this ties back to my comment about the discount the market applies as a consequence of the complex and vertically integrated structure that MinRes operates under. Another point, a similar point, is its $2 a tonne margin claim that seems to come up in respect of every single service provided by CSI to every aspect of every business that it services. I mean, that doesn't make any sense.
No, and the fact that you can simplify CSI, what are they like? To everything simplifies to these units of these volumes, these tonnage volumes, and so we just apply $1 per tonne to a volume of like. To your point, there's no way that a crushing volume is the same as a haulage volume. Like they're fundamentally very, very different margin types of businesses.
They get asked this question every quarterly, just about, and they always dodge it. Always.
Well, that's what I'm here for, to push for more transparency in respect of MinRes disclosures.
Yeah, and there have been, like, for example, the latest reserves update on Onslow as well. That was a big improvement. There was, disclosure about what future capex looks like, a wash plans can be required, things like that, which probably have been part of the thinking for a long time, have finally started to come to the market in a more forthcoming manner. I welcome more of that, like more of that transparency. I think is a positive.
You know what, mate? MinRes have pretty swish digs up at Onslow. I know you've seen the pictures, right?
I've seen them, mate. Yes, they talk about the Great Cairns Bore Retreat, but they're not the only ones building these flashy, very, very accommodative camps for FIFO workers, mate. Grounded Construction Group, they've been doing this for years. They've really brought out some absolutely stunning camps for FIFO workers across the state.
You're on the money, mate. And there was a big announcement earlier this week, or maybe late last week. They're building a new accommodation set up in the mighty South Headland.
The South Headland premium accommodation is coming, mate. It's a $60 million camp, 297 rooms. We're talking rec room, all of the perks. This thing's going to be swish and special, and it's being brought to everyone by Grounded.
It's true, mate. And I think we really need to hammer this point home, why it's so important, because you need to keep the workers happy, right? High turnover are high costs, and that hits your productivity, and that goes on and hits your profitability. So if you want to have...
Mate, this sounds like what Jack Tooley wrote in the AFI just the other week.
Jack Tooley. And it gets better
Research
than that, right? What do the workers want, mate? Comfortable rooms. They
Good
want
night's
quiet
sleep.
rooms.
Soundproof.
Spacious.
Acoustics.
Not asking for a lot.
No, it's simple. And you know what, mate? Grounded gets workers, and if workers are happy, that helps the bottom line. That's the message.
Get in touch with Paul Natoli and the team at Grounded. Get yourself a new accommodation set up wherever you are in WA.
Go Grounded Construction.
Go Grounded.
Yeah. Well, actually, on the theme of transparency, I don't think we should move on to the actual operations until we spend a little bit of time discussing our beloved CEO. It might be easier if you give me your view on Chris Ellison first, if you're willing to, and then perhaps I can comment on a phenomenon that I'm wrestling with at the moment in respect of his effect upon this company.
Nah, you first.
Well, I have nothing but positive words in respect of Chris Ellison's talent as a mining executive, and perhaps you and I disagree a little bit on this, but I think he's a genuinely skilled operator, and I think that he does get projects done that wouldn't otherwise get done, and he gets projects done faster than other people would be able to do them. He hustles harder than any other mining executive I'm familiar with, and I think for me, a lot of people like to spend a lot of time trying to find the best asset on a piece of paper. They want the holy grail of mining investing is the highest grade ore, the largest ore body. You've got institutional support from JP Morgan. You've got you've got you're going to end up with, you've got the projected lowest costs on a unit basis, and then the project sits there for 5 years and 4 cap raises go through, and at the end of the day, the prospect of outsized shareholder returns, despite the strength of the asset, are minimal. On the other hand, you have a company like, or a person like Chris Ellison, who he'll take an asset that perhaps isn't on paper the highest quality asset in the world, and I'm thinking of something like, in the lithium space, something like Mt Marion or even Wodgina, but he'll just start mining the bloody stuff, and he'll do it quickly, and he'll cut costs where he can. And for me, it is very easy to prioritize asset quality to the detriment of returns investing in this space. I will take a second class asset with a first class operator any day of the week over a first class asset with a second class operator. That's the foundation of my views about Chris Ellison's role as a talented mining executive. But what I will say is that he's put us all, and by us all I mean people who invest their money in this company, in a fairly unfortunate position, because, I mean, I've asked you this, Trav, before, but I'll ask you again for the sake of your listeners. If you were plopped into the CEO seat tomorrow of MinRes, what would be the first thing you do?
Well, first thing I'd do would be get the real numbers.
Yeah, and then what would the second thing you do be?
Second thing I do depends on what the real numbers are.
And if you had to have a guess at what you think the second thing you do would be, given what we know?
Well, it totally depends. Like,
the answer I'm fishing for is a cap raise.
It would be a cap raise if peak net debt on your numbers still has a isn't actually coming till, call it, the end of this calendar year or a bit later.
Yeah.
Then it would be a cap raise.
Yeah, and that's what I think is happening with peak net debt. Although we can come back to that later. I think any professional CEO in this company would do a cap raise before the seat was warm. And yet, Chris has resisted pressure to do that for the last 18 months. His interests are aligned with shareholders in a way that I think is unusual in this space. But as a consequence of that, I feel like and I've observed this phenomenon in my own mind. I feel like we're all subject to a form of Stockholm syndrome. It's not normal that when I'm reading the AFR's 7th disclosure or 7th piece about some misconduct that they're alleging Chris Ellison to have committed, it's not normal that I'm reading that with one eye closed and fighting the dissonance in my mind with every second sentence, trying to justify why, this actually isn't that big a deal, and come on, this was 15 years ago. That's not a normal pattern of thinking, and yet it's one that so many of us have been forced into as a consequence of our desire to avoid plainly destructive actions that would be taken by anybody other than Chris. And this is the phenomenon that gave us the truly paranormal, which was a standing ovation at the AGM, at which he was apologising for historical misconduct, for what was played in the media as a tax evasion scandal. But if you take the allegations made in the AFR at face value and you assume they are true, and I have no other information, I have no independent reason to think they are true, but assuming they are true, this was not just a tax evasion scandal. This was the knowing misuse of corporate funds for personal enrichment. And so I think that genuinely talented individuals are often flawed. I think Chris Ellison is evidence enough of that fact. But I do think something needs to be done to try bring shareholders around to a more comfortable position. I don't think it's sustainable that big super funds view this company as uninvestable. I don't think it's sustainable that there's lurking in the background the constant danger of some new article in the AFR alleging some manner of historical misconduct or some manner of failure of disclosure. what I'm saying is, if there's a way to have the good without the bad, I think all of us would be grateful for that opportunity. I've realised I'm sort of monologuing now. This is a bugbear of mine, but
it's a really interesting train of thought. What is the sort of solution there, or what is the idea? Is it sustainable with Ellison?
Well, I think what they should do is show that they are committed to transparency by being far more open about the operations of the company.
And do you think they've made the first steps in that direction?
Yeah, I do. Yeah, I do. And I think the company should be applauded for that. And I don't think I have as negative a view about the intentionality of some of this past conduct that maybe you do, Trav. I think that there's a decent chance a lot of this got caught up. A lot of these disclosure or mistakes of disclosure or absences of transparency in their disclosures have been the consequence of past decisions, not recent deliberate decisions to mislead the market. I don't think they've set out to mislead the market in any way, but I do think that has been the effect, if not the intention.
I often think back, talking about Chris Ellison and his role sort of running this company, stewarding it to the tremendous shareholder returns that we had from IPO to recently, and subsequently the erosion of shareholder return in the recent years. I often think back to the question that was asked, not at the last AGM, but the AGM before that. A shareholder gets up and
I think I know where you're going.
Yeah, and asks, how do you think about hubris? It strikes me that a weakness of yours or the company's might be.
Do you remember his response to that question? Because I remember the question, but I don't remember his response.
Yeah, Chris handballed it to James McClement, but it was a funny kind of way it all evolved. I'm not entirely sure that Chris knew what the definition of hubris was, and that's why he handballed it. But it was regardless, it seemed a funny interaction. Like the body language was really intriguing, and why I still think about that is I 100% think hubris is the biggest weakness of Chris as a capital allocator. I think that level of hubris, it's like you're rolling the dice, and there's a probability you'll be right.
You're winning each way.
And he's had a freaking hot streak. Yeah. He had a really hot streak. But if you keep kind of rolling the lot on the next roll, and at some point, you're not in charge of the macro, you can look pretty silly on the capital allocation front. And I do think a lot of the lithium investment, the $1 billion that went into hot copper lithium stocks and the like. I don't know how you justify that from a capital allocation perspective, and how you kind of back solve the lithium price assumptions that were so distinctly different from the market. Why did you deter from consensus by such a by 2 standard deviations in your assumptions when you're bidding on these things is still a big question mark to be had.
Yeah, I tend to agree. I think that success, and this is not the sort of comment that I would usually think goes that is apt in respect of a company like MinRes, but I do think that success can breed complacency. And although Chris Ellison doesn't strike me as somebody who's complacent, he does strike me as somebody who trusts his gut more than perhaps it is prudent to do. And I think he's been right in a number of respects. And as I'm sure we'll get to, I think Onslow may well prove him right on an enduring basis. But there's too many unforced errors that I think by their nature can be solved, and I think it would redound to the company's benefit to do so. And I don't see any downside. I don't believe that this company is hiding information that would make the company reevaluate the entire mining services business and come to the conclusion that this is actually a C grade services business rather than the A+ grade that everybody has given it in the past. I don't think that's likely. And I don't agree with you, Trav, that their operations that they are servicing are marginal. At least I don't agree that Onslow is a marginal operation. So I think that the mining services business will go from strength to strength over the next 5 years.
Let's take Marion and Wodgina. Do you think that either of those joint venture partners, other than MinRes, would like to close those operations down?
Well, I think you've reported that Albemarle is desperate to close down Wodgina. So I'll take that at face value. I don't think Ganfeng is keen to close down Mt Marion.
No, I think they're happy for that to stay open.
Yeah, but I mean, MinRes would keep Mt Marion running even with spod at the US price for SC6 equivalent at 300. I would have thought. I think that they're banking on those mining services, that mining services revenue stream. I do think they're probably telling the truth when they say that those operations are cash flow positive from a MinRes point of view. It's obviously not. The JV is obviously not cash flow positive at either of those lithium mines, but I think it's likely that MinRes is happy to leave them running at the current spot price because I think they're either generating cash or are sort of break even. You're a bit more bearish on that side of things than I am, I think. Or bearish is maybe not the right word. You're a bit more negative on the viability of those operations at this price.
Viability is an interesting one. I think I don't. I think if you look at the JV, so the best of my knowledge, both of those JVs actually require mutual agreement or mutual consent to actually cease mining or cease operations.
I think MinRes might be able to shut them down of their own accord as the operator of each. I'm not sure about that, but I certainly suspect. I think it's clear that the other JV partner cannot unilaterally insist on care and maintenance.
Yeah, things can get ugly. If it was like a more public kind of display of wanting that operation to be shut, things could get ugly that could kind of force that to happen. I do think. I see your analysis, and it's not like you're actually forecasting positive free cash flow from the lithium business.
Yeah.
So I think
when you say, we should probably set this up for the viewers. When you say you see my analysis, you're talking about the financials that I've shared with you privately.
Yes.
Not the financials. That's going to give the
Your
wrong
forecast,
impression to
your
any.
cash flow forecast.
My cash flow forecast.
I think that's a fair base case assumption. I do think the business at current prices, all in mining services, everything. I wouldn't be surprised if there were operations from time to time that are actually bleeding cash. But TBA, there's also a well reported rumor that MinRes is looking to sell up to 49% of Marion and Wodgina, whilst effectively retaining kind of control via whatever that JV is in the decisions to be made in the respective mines. But
I think that would be a tragic mistake.
Everything's got a price.
Well, I think assuming any realistic price, I think that would be a tragic mistake.
I think what you've said is sort of bang on for the lithium business as we stand and for the say 1 to 2 year period. But they're clearly not running gangbusters. Wodgina will get to a point where more capex needs to be kind of spent. So
Marion too, the float plant is a priority of Ganfeng.
That. So that's an acceptable sort of situation for the short to medium term, I think, before a real decision has to be made.
Yeah. I mean, and again, this is a product of, this is somewhat a product of our uncertainty surrounding this. Is somewhat a product of the absence of detail in some of the disclosures around these operations. Who knows what capex has been deferred at Wodgina? Who knows whether they're high grading it or not? Well, we can guess, but you would think in the current price environment they would have to be high grading it. In fact, I think that would be almost prudent. But the good news is none of this matters. If Onslow performs, then the lithium revenue is merely a drop in the ocean compared to how much money they'll make up north.
So this is the point, I think, of contention and importance to peel out is how, I suppose, how you've come to have a very positive view and even medium term outlook on Onslow's ability to generate real free cash flow, and B, how you consider like the risks to that view.
Yeah.
And there we might differ.
Yeah. So I think I'm not sure how well your audience is likely to understand this operation, but this project has been quite a long time in the making, and I think it's been something of a passion project for Chris Ellison. I think he, a long time ago, identified these.
He bid for Aquila back in 20.
Well,
I want to say 14.
14, I think. Yeah. So he identified these tenements as capable of producing iron ore at a competitive price. That was a view contrary to the views of most other market participants, and I think that was because of the distance the tenements are from the nearest deepwater port and the associated costs of running rail from where these mines are. They're about 150 kilometres southeast of the port of Ashburton.
Keep in mind, when Aquila was ultimately taken over, the successful bidders were, it was Bow Steel in consortium with Horizon, a rail provider.
Yeah.
Horizon ultimately, did, after numerous studies, thought that there was no potential for rail at this operation, hence why they were willing to kind of offload their stake in Aquila to MinRes for, I think it was like $10 million. Wasn't very much, their stake in Aquila. Yeah.
Yeah, and MinRes agreed in respect of the feasibility of rail, and so instead, the project is the tenements are connected to the port of Ashburton, which is not a proper deepwater port, via a haul road, the highway to hell that has been the cause of so much of the drama surrounding this company over the last 12 months. But then, of course, even once you get the ore to the port, it's loaded in an unconventional manner because the port is not a deep water port, meaning that proper Cape-sized bulk carriers can't get all the way in, meaning that MinRes is instead loading shallow draft transhippers, which are, in my view, an incredible piece of technology. Transhippers are not new, but MinRes, these transhippers are, from everything I've heard and can see, remarkably efficient isn't the right word. Remarkably entrepreneurial, I suppose. And then these transhippers take the ore out to the waiting bulk carriers offshore. Where were we going with this discussion about Onslow?
Sort of the background history, right, from 10 years ago.
Yeah. So, and so the reason all of this is interesting is because these tenements were considered to contain stranded ore in the sense that it wouldn't have been economical to transport them via rail to a deep water port. MinRes has developed this project on the basis, the most recent updated disclosure assumes that they'll be mining and shipping the ore on a free on board basis at 49 Aussie per tonne. So that number itself is lower than you might have thought it would be given the situation.
This is a fully ramped 35 million tonne per annum scenario, not including third party like haulage, which they're heavily utilising right now.
Yeah, and the costs that they've reported so far, they're not including capitalised development costs, obviously. So query where exactly this is going to end up. But that number is a little bit deceptive, I think, because that $49 a tonne number is a little bit deceptive because built into that is all of MinRes's margins on the mining services side of things. And so that's $8 a tonne in margin for MinRes mining services. But then there's also an $8 toll fee that's being paid for every tonne, and half of that comes back to MinRes. So there's $12 of margin in that $49 number for MinRes, which means if you strip that out, and this is I suppose, a fairly crude way to look at it. But if you strip 12 out of 49 and you end at a $37 a tonne basis, and you can imagine from MinRes' point of view that that's one way they see this project. Suddenly, this is a highly competitive bottom 25% quartile, lower quartile iron ore project.
When have you ever seen a company's projected costs from a feasibility stage or pre-development stage match your actuals in Australian mining history the last 5 years?
Yeah. And they've been revised. These costs have been revised upwards twice now. But I do think that we will have a better understanding of what's happening in terms of the cost per tonne, not in this coming quarterly, but probably in the next quarterly.
I still don't think anyone properly understands the cost space at Onslow. There's not a good appreciation of what unit costs are at Onslow, and realistically what they could get to.
Well, in terms of the haulage, so this discussion generally relates to the haulage. The discussion of relating to cost at Onslow relates to the cost getting the iron ore from the mine to the port. I think I don't think there's a whole lot of consternation surrounding the actual mine operations themselves. It seems pretty basic. It's low strip. Do you have any views about the actual costs on the mining side?
I think naturally your strip changes over time. But yeah, and I obviously think that your costs are also going to change as a function of where you've been. You mine the highest grade of a deposit earlier, and by all accounts, you can kind of see the deposits they're bringing into the mix are kind of optimizing for high grade, low impurities, but that does deplete relatively kind of quickly, and then
sure.
Then
but the other side of things, scale allows you to shrink your overall cost basis because of the nature of scale. You have fixed costs in some respects, but you also have costs that aren't fixed. So if they ramp this beyond 35 million tonnes per annum, I don't think it's unreasonable to assume that cost basis will come down.
You think the cost basis long term will actually be below 49 Aussie?
I'm not sure, but there's a big question mark surrounding the haulage side of things for me. But I don't think it's fair to describe this as a marginal operation. I think that this is competitively positioned. I think that it's competitively positioned subject to what happens with haulage. And that's a big question mark for me.
Yeah. And the way to think about, so you look at that $49 a tonne, the Onslow site visit presentation, they broke it up into three components. $14 per tonne for what they call other mining costs. Then there's the $27 per tonne, which is the services you're talking about. That's crushing, haulage, port handling, and transshipping. So there's four things. People are assuming there's $2 to each of those category per tonne.
Well, the company has said there's $2 to each of those categories per tonne.
And then there's the $8 road trust. The whole road fee. So, but look at the $27 per tonne bit on the services front. Now, that's kind of like a contractual price to deliver to Mineco at MinRes' services effectively. So people think that there's $8 a tonne of margin there. But what came out of the last quarterly was there's a clear example of, this mining CSI has to wear margin erosion because they've guaranteed the price of these services to Mineco, and at the moment they're relying on third-party contractors for haulage, which is basically clearly meaning there's not $8 a tonne of margin there.
Yeah, I tried to do some digging on this side of things in particular because I was concerned that the haulage situation might make this uneconomical or significantly reduce the economics of it on an ongoing basis if the road was to not to be built to spec, basically. And I think that so far as I could see, if the MinRes triples are not autonomous, the MinRes thinks that they will cost them about 6 cents per tonne per kilometre. I assumed 7 cents. I had previously assumed 7 cents per ton per kilometre. The contractor trucks are double that. So double that's 6 cents per ton per kilometre. They cost them about 12 cents per ton per kilometre. But the company thinks that if they go autonomous, that 6 cents per ton per kilometre can be brought down to around 3 cents per ton per kilometre. And that's competitive with rail. I think that may be a little bit ambitious, but even if it's in the ballpark, then
Do you,
that
do you think that 6 cents per TKM is assuming like the full 330 payload and cycle times that are average cycles per day, which are still kind of in the ambitious range of things?
I'm not sure whether the average cycles per day are in the ambitious range of things. That's something else I've been trying to look into, and I think that they're probably more likely to achieve their cycle times than they are to achieve their full load projections. I think that what's likely to occur is that they're going to run their triples at reduced capacity. I think that's basically inevitable, actually, at least for the not foreseeable future, at least for the medium term. Now that may flow through and push that cost up a little bit, but I mean, again, part of this is a function of a lack of disclosure around exactly how what they're going to do with these trucks going forward. But if we assume that they're loaded to 300 tons, which is down from 330, then I think that 6 cents per ton per kilometre is probably not unrealistic from everything I'll be able to find online.
Right. Here's probably where I have a different risk outlook on the project's kind of capability to sustainably deliver kind of nameplate, and sustainably deliver is the key word there. The moment you get rid of your contractor road trains, well, the contractor road trains are actually not operating on the whole road. They're taking a different path. They're using
for some of it at least,
the access road for a bit, and then they're using the public highway. So it's a longer route. These are smaller trains. So if you remove the contractor trucks and you suddenly have an enhanced reliance on be it a combination of MinRes' jumbos, plus there might be other size trucks that are also operating on the whole road. I think you're depending on what you're actually loading these trucks at, you're probably coming into a pretty dicey position with the extent to which your whole road is kind of capable of that load in an unproven way. Yeah.
You're talking about the actual underlying structure of the whole road.
I am. Yeah.
Yeah. But this is an unknown. I have found absolutely no reliable way to work out what's going to happen with this road. There are people who say that the actual composition of the base course is necessarily stuffed as a consequence of a lack of available material when the road was built. On the other hand, the company seems to have the view that the main problem was water ingress. It wasn't the actual underlying composition of the road, and therefore asphalting it and playing with the shoulders a little bit, extending it, being more careful around water will deal with all of these problems.
Both of those things can be related.
Because of course.
Your water is the enemy of roads. Like when it gets into the sub base, then your chemical bonding and everything can be pretty compromised. And
When you buy the stock, how do you get comfortable with that then? Or do you think that's something that might play out in 18 plus months and that's not in my time horizon? Or
it's very difficult to know. I think that over the next 6 months, the company will get a better idea of what's going to happen with the road. It's been reported that they're monitoring it quite carefully. They're using GPR, ground penetrating radar, to try and to try and keep an eye on any movement subsurface. But it what they're doing now shows that the road can take, say, 260 tons on these trailers.
Yes, which is a prudent thing. And just because it can take that much right now doesn't mean that come January, February, it'll still be rosy.
Yeah, and the unsatisfactory answer to all of this may be that we just need to wait and see. But I think that the risks are weighted to the upside in respect of the company's operations at Onslow generally. I think that I think that the dispute between the initial road contractor and MinRes has been overplayed a little bit in the media. I think that there were some sort of I'm not sure if it was the Fin Review or the Australian who reported on this, but there was some innuendo around the quality of the actual road composition. But I think were you to ask the people who built the road, I think they would say, actually, we built a road. We built a really good road.
This thing, I don't think we've ever properly hashed out on the podcast. Why maybe some of the intuitive science behind why the road is such an important kind of piece of things. And in civil construction and road design, there's this thing called the fourth power law. Fourth power law of road design. What is the fourth power law? Well, the fourth power law.
I know what it looks like.
Yeah.
It looks like this.
You can picture an exponential curve to the power of 4. Well, that's the relationship between the maximum axle weight of vehicles on a road. The change in that is directly proportional to the road damage is directly proportional to the fourth power of the maximum axle load.
And so what you're saying is small changes in load can have outsized effects.
Tremendously outsized. If you just take a look at a typical standard road train, maximum axle load is 8. Now, MinRes ones are 20. These are public numbers. That's 2.5 times the axle load. But your effect on road damage is proportional to the fourth power of 2.5.
So it suddenly doesn't look like a difference between 8 and 20. It looks like a difference between
it's like 40-ish times the road damage you'd expect of a road that is that's the intuition behind like why this road matters a lot. And the people that built the road, I'm sure, like they did the numbers, they know this stuff. They built roads before, and they would have built it to spec, but to hopefully be able to manage this in the way they could. Now, it doesn't. What I do mean though is like if the road were designed to handle a maximum load of 20 maximum axle load of 20, but they were overloading in the early days, for example, to 24 or 25, or maybe the distribution of the axles across the vehicles wasn't properly like understood. There was some variability there that has a massive impact on kind of what you can expect to happen on the road. And the other working assumption I have when thinking about the risks of the road is the way I think about a road is you will see road failure in the first couple of months if there were things that were if there were design components were not up to scratch, and you will know in the first couple of months. A properly built road will be durable for 50 years, and you will never have to do any maintenance on it. So my working assumption, like you think of like freeways in the United States, they're loud as all hell or whatever, but those things they're basically like built with sufficient characteristics to have your certain thickness of road base and all that kind of stuff, all those materials, yada yada, so that they can endure without maintenance for the longest period of time. Think of your airport tarmacs; those sorts of things are the same. But if it's not built to the right kind of specs for what the ultimate load's going to be, you'll see that very quickly. And I think we did see that very quickly with MinRes. And my working assumption is that it's not necessarily going to be a case that you can remediate it with some cement fill and asphalt, and it's going to be durable again for 10 years. In fact, like I'm very concerned about when you have your summer months, January, February, It's going to be very hot. That's when the road's going to be under a lot of stress. It's also going to be very wet. And, depending how much cement has kind of been put in to stabilise the road, you're at risk of different types of risks, like block failure. Now, all of that to say, like, the road remains a key risk. What it can really credibly do remains a key risk. All that to say, but I'm amazed that they're achieving an annualised rate of 35 million tonnes per annum right now with the reliance on contractor trucks and using kind of effectively half a whole road because they're doing repairs along it at the moment.
It's incredible. It's part of the Chris Ellison magic.
Well, the question to figure out is like, and we know that the repairs to the whole road, all of that costs is going to be borne by MinRes. So that's 100% MinRes's. What is a realistic number for the annualized? Like that, so if you look at what they're getting for their share of the whole road, the 50%, it's like 150 million bucks a year, right? They're spending twice that right now just in repair of the whole road this year. So what should be your annualized number of like your annualized capex expectation for road maintenance? I'm sure it's not $300 million. I'm sure it's less than that because they're doing the asphalting and everything. But that's that kind of cuts into your margins pretty clearly, in my opinion. And if it also inhibits your maximum allowable volumes, which it obviously would if you're having more trucks. You can't just keep adding trucks and trucks to expand. There's some maximum trucks and some maximum loading that this road is going to be able to handle on a durable basis, and that was clearly exceeded beforehand.
Yeah, it's interesting that there's been no talk of long-term reliance upon contractor trucks.
Yeah,
because will we see a point where they say for the next 6 months we're only willing to run X amount of tons along the haul road? We need a year observation, so we will make up the shortfall using the contract trucks, and they've shown that they can do that. I think that would place upwards pressure on downwards pressure on MinRes's revenue, upwards pressure on the costs involved in getting this stuff to port, getting this ore to port. In the presentation that accompanied the mine visit, I think there's a line in there where they say that once the road is repaired, there'll be essentially zero sustaining capex.
That's a phenomenal line.
Yeah. That it's not so much that strikes me as perfectly realistic if everything goes to plan.
It strikes me as incredibly unrealistic given the road needed repairs.
Yeah, well, that's what I mean. That's what I mean. So what I'm saying is, what's the basis for saying there will be zero sustaining capex in respect to the road unless they are very confident that these road repairs have solved this problem?
I think like the company does have a history of disappointing on capex expectations from a sustaining perspective. Like I don't, and you've spoken about that too. Like I don't look at that number. I think that number, the expectation, maybe is guidance to hopefully alleviate, the market that, things are going to be okay from a balance sheet perspective. But like my thinking is that the whole road, assuming there's going to be zero maintenance capex on that whole road after these repairs, like I think is kind of a wacky assumption to realistically have, given the reality of how a bit of rain transpired there, and if the sub base is compromised or all of that kind of stuff,
throw it out and start again.
I'm not a civil engineer. I'm not an expert on this stuff, but I don't think you have to be to intuitively kind of recognize the risks with assuming a zero maintenance capex.
We should probably then mention the upside risks, which is that some of these problems can be alleviated or at least fudged if you push the project beyond 35 million tonnes per annum, if you're able to. Suppose that they covered the increased cost associated with the road with increased shipments of iron ore. I'm pretty bullish on the capacity of this project going forward. I think that putting the road to one side, they've demonstrated, or they are in the process of demonstrating, that they can push everything else beyond 35 million tonnes per annum. And my read on what's happening on the port side of things is that the project is performing phenomenally. in terms of what capex would be required to push the project beyond 35 million tonnes per annum, we know that they've already ordered 2 more transhippers and they're arriving next year, taking it up to 7. They're everything I have seen and have heard suggests that 5 transhippers operating at capacity is alone enough to get this project to nameplate or beyond. The question then comes, can they build out to 40, 45, 50 million tonnes per annum and go from there? My view is that the market is overestimating how much it will cost to push beyond 35 million tonnes per annum, or is perhaps underestimating the likelihood of that occurring at all. And I think that they've shown, were it not for problems with the road, assume the road works perfectly, I think they've shown that with 7 transhippers in operation and some work actually at the port concerning the channel that the transhippers use to come in to shore to be loaded, I think they'll be able to push this well beyond 35 million tonnes per annum. Just on that channel point, I think that what's the only real bottleneck at the port at the moment is that they're sharing one single quite narrow channel with Chevron. So Chevron has the Wheatstone LNG project basically on top of where MinRes is operating at the port of Ashburton. They're right next to each other. And that means that almost once a day, Chevron brings in an LNG tanker or takes an LNG tanker out, and Chevron has priority over the shipping of the maritime operations when that's occurring. And so it seems that MinRes can't actually use their transhippers while that's occurring. They can't bring them into load or take them out from shore to the carriers. So my understanding is it may be possible to come up with a workaround for this problem with a bit of dredging. I was actually told that this was not from somebody who works at MinRes, but from somebody who understands what's going on there. I was told that it may not be expensive at all to dredge or to widen that channel such that this is no longer an issue. If that's the case, then I think that the one impediment to shipping occurring beyond 35 million tonnes per annum could be removed. If that does transpire, then we're back at the road. We're back at the road being the bottleneck. Do you have a view as to where this project can go beyond 35 million tonnes per annum?
Let's get to 35 for a year first. I'm intrigued by the opportunity for expansion. I think like the upside's an interesting case to explore. I think there was actually a brief window, I want to say it was in 2024, where Chris was telling the market this is going to be 50 million tonnes per annum. And then he also guided CapEx that was kind of sharply higher than expectations. And there was a port kind of allowance that was the main factor for the huge increase in expected kind of CapEx. So I'd challenge the proposition that the dredging is a cheap thing to do. I think it's quite an expensive endeavor. I think like the discussion of the expansion comes with it like a very uncertain, like how they're going to fund this, right? Like, it's all well and good to talk about expansion, but the first thing you think of is, well, that's a lot of CapEx and like the balance sheet's already stressed. So where's the free cash flow to fund this expansion? Yeah. It's got to be proven to be free cash generative substantially before the market is even told about expansion, in my opinion. Like, because expansion comes with CapEx.
Well, speaking of the need for money to fund CapEx and the balance sheet, do you think they should do nothing right now, focus on operations, and then earn their way out?
I don't. Like if you looked at the last quarter, their cash at bank was like $400 million. They had an $800 million revolver, which was undrawn, which they could draw. I don't have any reason to believe that they can't draw the revolver, although I do think there's some uncertainty in the market about that. Like,
Yeah.
I'll believe them at face value that they can draw the revolver.
Yeah.
But for like the purpose of a hypothetical, let's assume that they can't draw the revolver. I think $400 million is a completely insufficient like level of liquidity for the nature of this business.
I think they would have had to act before now if they weren't able to draw on the.
Well,
on the RCF.
they're absolutely running a sale process for up to 49% of the lithium business. So they are acting like, and I think like whether they pull the trigger on that or not is TBA, but they are doing all things to act on adding more liquidity to the business.
I find that to be a very curious decision if that's what they think is their most favoured response, their most favoured method of raising money. It doesn't make sense to me, actually. It doesn't make any sense at all. I think that, well, first things first, are they surrendering the mining services contracts over these?
49% would mean that they still control the JV.
Well, then who's going to pay them the money that these assets are worth?
You run a process to find out.
I don't know.
It's insanity.
I don't know.
You would have to think they would sound out the bondholders and see what needs to be done to, reissue bonds and roll the debt, right? And that would dictate how a lot of conversations and which levers are pulled.
Yeah.
It depends. In some respect, what happens with interest rates in the United States will be important. But why turn to your lithium assets that are currently being valued in a market or on a basis? If you value them on a NPV basis, they're worth nothing.
But I think quite clearly they're not going to sell them.
No,
if
no.
It's only if they get a price commensurate with.
They're an expensive option. Like, I feel like it's expensive. I mean, it's a valuable option on lithium price is how I view their lithium business. I think they could get a reasonable amount of upfront kind of cash. Curious to see how they might structure something. Curious to see what type of buyers there could be. I'd also be surprised if the bidders didn't have a view on, like, they'd absolutely want the marketing rights with volumes. I'm sure.
Yep.
The mining services contracts is a pretty interesting part of the puzzle because I'm sure MinRes would be unwilling to compromise on them, but that could be a pretty sticky point of contention for certain.
But that's what I mean. And suddenly this looks like a forced sale if they're compromising.
Of course, it's a force. Of course,
but
it's a
then
force
why
sale.
start with the lithium?
What else would you
you've got three interesting levers as well. In an ideal world, they get $500 million from hitting the target on the road, 200 million, and another 300 from the energy assets over the next year, and then monetizing the loan.
Yeah,
would be
the carry loan. Yeah,
the carry loan, which is sort of 790 as of last reporting.
Well, the carry loan's an interesting one, and the carry loan's not going to lie about the cash dynamics at Onslow.
But yeah, so that's a separate point. But the antecedent point is, why don't they just sell the carry loan?
They can. I think that they've sounded that option out historically, and it's an expensive endeavor. You're foregoing a pretty substantial, risk-free rate for enacting on that transaction.
But is it a risk-free rate?
Well, yeah, precisely. In MinRes's view, it is, right. So if you had to transact on that, it's
it bewilders me that they haven't already done this. I would have thought that would be the obvious option, and I can't imagine that. I mean, and this is where I'm desperately struggling to avoid falsifying my thesis as to the viability of, or as to the not viability, as to the nature of the Onslow operations, because the fact that they haven't sold this already is perhaps a hint that Onslow may not be viewed as favourably by other market participants as the company views it. And
I'd flip it. I'd flip it. I'd say I'd try and argue that maybe the market maybe MinRes now has a more somber view on lithium outlook than they historically did. Right now, if MinRes has internally come to the view that, look, we don't actually see too much upside on the lithium price for a long period of for a fair number of years ahead here, and that's kind of consensus outlook. Well, if you can, like you say, if the MPV is zero, maybe you can actually sell it for 49% for, you know, up to $1 billion. And that's a lot of money for something with MPV of zero, but you've kept the mining services contract, and maybe you've even kept some marketing volumes, like, and you've kept some equity upside because you still own a fair bit.
Yeah.
Like, I think that's a pretty prudent like transaction to have. I think the stock would rip if they did it because they alleviate a lot of liquidity concerns in the process.
You are building into that a very bearish outlook on lithium over the next 5 years.
Not even bearish. I think it's just like who knows? Like, I'm not kind of in the business of predicting commodity prices, and I'm certainly always cautious of when a mining company predicts commodity prices. I think the value that MinRes sees in those assets is increasingly more towards the mining services contracts attached to those assets rather than the equity in the actual, you know, mine.
The other option is to sell the other half of the road.
That bit doesn't
What would you
make
get for
sense
that?
to me.
I certainly don't think you'd get anything more than what you got for the first half. I saw that there was some amusing speculation in the Australian that they would get a hefty control, that if they sold the other half to Morgan Stanley would pay a hefty control premium.
Yeah,
which makes absolutely no sense to me.
Wonder where the leak came from.
That is just a puzzling thought after what has happened since Morgan Stanley bought the 49%.
Yeah. But you have to remember that what they've sold is not, you know, Morgan Stanley isn't on the hook for half of the repairs to the road.
Correct. But Morgan Stanley don't get paid if MinRes fails. The mine doesn't work.
If the entire company fails.
If Onslow doesn't work, right?
MinRes still gets paid. Morgan Stanley still gets paid.
From what?
Well, yeah. So you're saying
what?
So yeah, sure.
So
you're
your
saying if
downside
MinRes
case
fails,
is not like an infrastructure asset, right? Like that thing's I just think that flexing the downside case from an infrastructure perspective has become increasingly a known thing in the market.
Yeah.
I'd be amazed if investment committee kind of approved a sale there and at a price comparable to what it was in the past.
Yeah, I tend to agree, but I still would have thought that it would be possible to sell. Or I still would have preferred, if I'm in the position of MinRes, I still would prefer to sell the other half of that future revenue stream for the same reason that I prefer to sell the carry loan. However, the negative view about either of those two assets, if we call them assets, may be the same thing, is what I'm saying, which may be why they're turning to lithium. But what I suspect the company would prefer to do is sell nothing. I think the company's strong preference is to sell nothing.
Do you think that the business's liquidity needs are sufficient to warrant selling nothing? You alluded to the fact that you think max net debt actually doesn't come until end of this calendar year.
Yeah.
So how can you justify?
Just on that point, I think that net debt when it's revealed Wednesday in the quarterly, I think that there's a very real chance it stays about where it was last quarterly. I think there are some participants in the market who think that it's going to start coming down. I think that there's a very real chance it stays about the same, although what happens with the currency may mean that there is a revision downward sort of on paper. That doesn't tell you anything about what's happening in terms of the cash coming in and out of the business. But basically, the reason I think that it's unlikely to have changed is because I think that we've had an extra 3 months of elevated spending required at Onslow. I think that 3 months from now, that number will start coming down. 3 months from Wednesday, I think it will be revealed to the market that number has started to come down.
I mean, the road is supposed to be repaired by end of September.
Yeah, I think the road's likely to be repaired by earlier than that.
Yeah, and you think that the max debt therefore will coincide with the capex kind of, ceasing.
Well,
reparation capex ceasing.
Well, yes, but more importantly, proper earnings from Onslow, repayment of the carry loan, and proper free cash flow.
The carry loan makes a difference. The $200 million contingent payment that
Yeah,
is expected.
of course.
Next half.
But you have to remember, and this is a mistake that a lot of people have made with this company over the last 6 months. Despite the failures of disclosure and despite all the drama that's been going on, we can actually get our hands around basic, what's the word I'm searching for? Veridical claims about the nature of these operations. We can see how much iron ore is being exported by this company. The numbers don't lie in that respect. And there's been a dramatic step up in exports over the last 12 weeks. So that ore is being paid for. Some of it in advance, but some of it's being paid for now. I do think the market is overlooking how much cash Onslow will be generating for this business over the next 12 months. What's the, assuming that the road holds up, what's the hole in that thesis?
Key risk is iron ore price.
Yeah, of course. But
I don't like. I'd be willing to wager that costs are substantially higher than $49 when everything's said and done. I just like kudos to them if they can execute that. But I just think the reality of delivering any project is one of costs surprise to the upside in a very inordinate number of ways that are originally maybe not expected. And granted, MinRes, they have the track record of delivering projects. This is completely different to any project they've ever delivered before. Like, this is enormous. This is not cool you're nobbing where they had to build the Carina Road. This is a transformative project. It's crazy that they built what they did in the time frame that they did from acquiring.
It's incredible.
It is like I'm not sure another team could have done that, but I think that comes with a lot of risks on costs, a lot of pressure to meet certain cost targets, and that can come out in a variety of ways. All of that to say, I don't think the costs are properly understood. I certainly don't have a firm grip of what the unit costs are going to be. You think that 49 is reasonable. I think 49 is unreasonable. Now, all that to say is, do I think it's an asset that is vulnerable to a downturn in the iron ore market? I do. Like, is iron ore being very resilient right now? Absolutely. Could they absolutely just milk the cow for a year and this, like, the debt's not a concern at all because iron ore prices are elevated? 100%. 100%.
Yeah, I'll make a number of comments about that. I think that the indebted position of MinRes is confusing our understanding of the cost profile of this project. If those costs are roughly right, then this is a low cost iron ore project. That's strip out some of the MinRes margin and convert it to on a US dollar cost basis and compare that to FMG's costs.
I disagree. Yeah, I mean, like, for one, they don't actually convert the tonnage produced when they show their cost curve. It's like presented on a DMT basis instead of a WMT basis. It's like there's a number of every cost curve is flawed for a variety of reasons, but this is.
But it's not a marginal operation.
How do you know that? Like, the carry loan's still going up. It's certainly been marginal today. On a fully ramped basis, like your point's received.
Yeah.
There should be a line of sight to, especially like on iron ore prices today. Like I'd be amazed if they didn't make free cash. But I don't think the market really knows what unit costs are going to be.
No.
I think the impact of third party like trucks is poorly understood. I disagree with your numbers on TKMs, both 6 cents and 12 cents for both cases. And I think they have
3 cents for
I think this is why the stock is priced where it is, where you think there's an opportunity, because like people like me are skeptical, and I think they have to prove the market wrong, right? They have to prove not just for next 3 months, the next 6 months. I think they have to prove themselves at this time next year. There's been a continuity of delivery and an absence of anomalies before. Like, it's the market can believe this project in its entirety.
Yeah, I do think that there's a risk that the reported costs in each quarterly over the last, well, let's just say the last quarterly, this quarterly, and the coming quarterly are misunderstood due to the the loss of margin for the mining services business. I think that MinRes is wearing costs that would otherwise make that number that was last reported at, say, 58 higher than 58.
Yeah, and in your experience following the company, when they have typically suggested capital costs, for example, might be a certain amount, have they had a tendency to be larger or smaller, or on par with what your expectations?
Yeah.
It's obvious that they've, I would struggle to believe the 49. I also struggle to believe there's zero maintenance capex on the road. And it doesn't mean that the costs can't go up, but it still have a project with sufficient margin to repay their debt, especially when iron ore is 105 US right now. Like it's a very healthy iron ore environment for them to be delivering this project in. But I don't think it's a project that is definitionally resilient to your worst case iron ore market.
No, perhaps not your worst case iron ore market, but it's easy to lose sight of just what has been accomplished here, given the few but fairly calamitous problems that have been run into.
You lose trust as an investor.
Yeah, of course.
Yeah.
But I mean, and this is what is truly crazy making about all of this, because if they had just been completely honest upfront about everything that had worked and hadn't worked, if they had said in January when this weather happened, look, we think we're going to have to redo the entire road from start to finish, and it's going to cost an extra 250 mil, 300 mil. If that hadn't happened, and instead what had happened was initially they had just said the road is going to cost 300 million more than they did say it was going to cost, everyone would say, well, whatever. This is still an incredible project of incredible scale, coming in at remarkable on a remarkable cost level. So it's very easy to get caught up in the day-to-day errors of disclosures and the day-to-day operational mishaps. But just take a step back and look at what this project looks like.
That point matters a lot. I've got no doubt that like part of the culture of MinRes that has created the very value generative business that it has been for a long period of time comes from this kind of just like attitude of making shit happen on a low budget, in a crazy period of time with people, breaking all sorts of records, doing things.
But I thought you were going to say breaking all sorts of rules for a second.
But it's that mentality that may also compromise something that is a key critical piece of infrastructure underpinning it. Like did they deliver the road with the same appreciation for critical delivery that this is, or was that same mentality of kind of build it on a much tighter budget than maybe was desired by some people, maybe with certain parameters or standards kind of tightened here and there with assumptions that may be optimistic. If you do that, if that's the mentality, and it's the typical MinRes mentality that also creates value, well then maybe you've also made yourself vulnerable. That's how I see the risks associated with the piece of infrastructure.
There's no doubt that the tsunami gathering force in the background is the debt, and that were you to take away this debt, there would be no doubt that this company had a lot going for it. Has the timing been unfortunate in terms of what's happened with the debt, the lithium market, the iron ore market to some extent? Yes, but I don't think that this project is being appreciated for what it is. And the meme out there that Onslow is a company maker, it's going to transform this company. Well, so far as I can tell, that's not just a meme. It is a genuinely transformational project. And I don't think we should look through that on the basis that it has some problems, it's unconventional, it involves tolled iron ore tons, which hardly screams low cost, and things have gone wrong with the haul road. I think that the problems are not insurmountable. There's no evidence that the problems with the road at this stage are insurmountable, and if they're not, I think that the valuation that is being given to this company by the market at the moment makes very little sense. At the end of the day, that's the investment thesis for me. It's not this is the greatest company in the world. It's going to be the next BHP or Rio Tinto. It's that the risks against the reward is not being calculated in a reasonable manner. At the moment, I mean, go back a week before the share price went from 24 to 32 or whatever happened back, but go back a week and the valuation of this company is getting pretty close to full-blown distress. And I don't think the company's in distress.
What was the either time horizon or target price when you bought in that you had in mind?
I'm pretty reluctant to give a target price because that's going to
Is that how you thought about it,
that's going to
though?
imbue my words with more expertise and confidence than they're worth. But yeah, I mean, look, my basic, and this is going to really trigger Trav, my basic sum of the parts valuation basically involved just looking at the revenue profile that the company's likely to earn on a EBITDA basis and chucking a multiple of 5 or 6 on that. A multiple of 5 to account for the fact that they've got a lot of debt. And you look at Onslow, the mining services outside of Onslow, and then let's just say a 0 on lithium for now. Take that revenue, sum it up, 2 billion, stick a 5 or a 6 on it, call it a 5, given they've got a lot of debt. That's 10 billion. What's the company trading at today? 5 billion?
Equity.
6.
Yeah, equity. But I'm using a multiple that's compressed, having regard to the amount of debt they've got. FMG doesn't trade on a EBITDA multiple of 5. I don't think.
Yeah. There's definitely different risk characteristics for sure.
Mm.
The EBITDA, like
the bullshit earnings.
This
Am I allowed to swear on this?
This is another gripe with the business as well. There is a huge focus on EBITDA.
But this can't be a MinRes specific gripe.
This is MinRes specific. This is not a widely adopted financial metric of any other mining company. Now, granted, there's a services company here, which of course, but why use EBITDA, right? And
well, I think the answer is they don't know what to do with the debt. It's very difficult to give free cash flow.
It's not just that. I think it's also depreciation matters a lot to this business. This is a capital intensive business. So why are we talking about EBITDA numbers and the interchangeability of EBITDA with profitable when when management talks is a very confusing component of the company. But I do think like there's a view maybe bankers have convinced the company of that, if you point to EBITDA growth, you point to strong EBITDA growth, albeit I can't remember the last quarter that they added net cash. Like honestly, I genuinely can't remember the last quarter that they added net cash. But EBITDA has continued to grow in a variety of different parts of the business, or at least quarter on quarter from time to time. Now, why has that been a focal point? Well, it's obviously debt covenants are tied to this thing. It matters to debt markets and the the utilization of debt markets in recent history, US bond market, etc. That's albeit their bonds aren't tied to an EBITDA debt covenant. Their revolver, I believe, is, but I just think you have to look at cash flow. You have to look at free cash in this business, and the recent history trend has been selling assets to mitigate what's actually happening to the ultimate liquidity and cash balance available. I hope that trend turns now that Onslow is kind of finding its feet. I've been surprised at the volumes that they're doing. I'm impressed at what they're capable and able to do with the reliance on third-party contractors. I don't properly understand the cost basis, especially given the reliance on third-party contractors. I'm nervous about their ability to preserve margin in delivering the costs that the market expects there, and I hope they can alleviate my nerves to that respect in the future reporting periods. Despite whatever sentiment that I've had from time to time, I've never had a position in the stock the entire duration we've been doing the podcast, and I'll continue not to. It's too spicy for me, right? It doesn't match my risk appetite.
That's a matter of principle more than it is a matter of the
it's
risk
both.
reward.
Certainly both. Yeah. the risk reward, I think it is still too spicy for me. I think you can have a non-consensus view of operational deliverability and still get pantsed by commodity price on the stock.
Yeah, there's no doubt that the price of iron ore, not the price of lithium, but the price of iron ore, matters a great deal to things over the next year and a half. But the sentiment around iron ore has been doom and gloom for
20
the
years.
last 20 years.
It's been a long time. Yeah.
Yeah.
What do you think endgame looks like
Endgame for
in 12 months from now?
I'm hoping what this experience has convinced the management of this company is that they need to just have a core focus and they need to do it well. I don't think that. I certainly hope we're not going to have another frenzied spree of genius capital allocation into whatever's sexy 3 months from now. I think, in that way, the debt may be a good thing. It may constrain the worst impulses of the company and force them to focus only on what matters. But I think were I to guess what this company looks like in 12 months from now, not the share price, I have no idea what the share price looks like, but were I to guess what Onslow looks like in 12 months from now, I would guess that it's operating at or above 35 million tonnes per annum in terms of exports. In terms of cost, I don't know, but I think there's a more than 50% chance that, certainly more than 50% chance that haulage goes to plan, the road holds up, and this project begins to be appreciated for its scale more than it is being appreciated by the market at the moment. What do you think?
God. Yeah, there's like a variety of different outcomes things can take on the balance of probabilities.
Can I share with your audience what you said to me when I said to you, do you think the share price of this company is more likely to be 55 or 0 within the next 12 months?
Did you ask 12 months? Is that,
I might not have said 12 months.
I think, yeah.
Because if
I think you gave
if I
a
recall
timeframe
correctly,
on it.
your answer was, I think it could be going to both.
Yep. So I do struggle to see like negative catalysts over the next call it 5 months. Like I don't.
Till summer.
Yeah. I think there's a lot weighing on summer, and there's a lot weighing on iron ore price. And like there's iron ore market suddenly looks healthy again after some weakness.
And the lithium market as well, perhaps.
Yeah. Yeah, I actually will struggle to give you a prediction because I think it's so commodity focused when you've got so much like debt in the equity so levered to commodity prices.
Yeah. But that's a very different proposition, and that's sort of I'm fine with that. I'm fine with this being a play on the iron ore price because the iron ore price is not high at the moment. It's not really low. I don't know how you describe the iron ore price at the moment. You could describe it as sort of floundering at a price that incentivizes production, but cuts out some of the very marginal producers. But yeah, if this is just a play on the iron ore price, then the risk reward is fantastic.
What key risks have you identified, and like are you kind of watching out for other than commodity price here?
Yeah, so other than the commodity price is the big one. The price of iron ore, I think, is more important and represents a more influential factor in respect of the success of this company than the other factors combined. But I will be disappointed if they sell the lithium business, if they sell half of the lithium business for anything. For any amount that they're going to get offered, I would be disappointed if they sold it for. So
any amount ever.
Well, that they're going to be offered realistically, yeah. I mean, they're not going to be offered. If they were offered $3 billion tomorrow for half the lithium business, sign me up. But I think that's struggle to even get $1 billion in the current market, particularly given the mining services situation. I think that if Chris Ellison were to be fired or to leave the company, that would be a major downside risk from my perspective. I think that people who think he is going to voluntarily retire at the end of this transition period are very confused indeed. If there was any doubt that that's not happening, I think that was put to bed when the chairman posted when the company posted the chairman's governance slideshow the other day that basically said Chris Ellison's not going anywhere. And that to me is a very positive sign, not because I think he's not because he's my idol, but because I think he's the only thing standing in the way of a massive cap raise. Other than those, I think the only real risk that is worth worrying about is the road. This uncertainty plays havoc with valuations, because how do you build in, what percentage are you assigning to the chance of the operation falling over because the road doesn't work? I've had to assign in my sort of model a 0% chance of that, but query whether that's realistic. But otherwise, I think all the other components of the Onslow export chain are working really well, and I don't think there's any risk associated with anything from port to carriers, and I don't think there's any risk associated or any real risk associated with anything from the ore to the road. What do you think?
I think it's I don't disagree. Like your point on Chris Ellison, that's I agree with, the market's not pricing in, or the market doesn't think that he's going to be leaving. I don't think there's any kind of query about that. To your point on,
if the board were to announce tomorrow that he'd been fired, do you think the share price would go down?
I do think there's a chance of that. And I don't think it's a zero chance, only because if there's heightened ASIC enforcement kind of warranting it, which who freaking knows where that's at or anything. But I'm just kind of I don't think you can assign a 0% probability to that. I think there is a chance.
And do you think what do you think would happen if that would happen?
It wouldn't be good. No. I do think shareholders think that he is, like you say, most aligned to get the company to a better financial and operating position, and B, can probably run the company in a way that no other management person could from a getting stuff done perspective. So I do think that'd be a pretty significant negative catalyst for the stock. On my intuition is that costs are substantially higher than what you think they are. And what does that actually mean? It means that depending where iron ore prices are, it's going to take a fair bit longer to pay down the debt than maybe you might think it to take down. And what does that actually mean? It means that you're vulnerable to a commodity down cycle for a longer period of time. Yeah. So that if you're just prolonging the period, you're kind of flirting with a high debt balance. You're kind of at any point in time one negative economic shock away from being in a very ugly position. So.
Which would justify doing something like selling half the lithium business for $1 billion.
Yeah. But it's been a pleasure to talk through the stock. I'm glad you became obsessed with it. I'm glad you've been willing to figure out your thoughts, bet on them, articulate them, and share them with the world. It's an admirable thing to do. There's plenty of MinRes bulls out there, but not many of them are willing to put their face to it. So I do commend you for.
They're not that foolish.
Well, a one stock portfolio. I don't know if I can endorse the merit of that though. That's big kahunas, mate. I thank you a lot for.
You're gonna have to bring me back on if it all goes to hell, and
come back in 1 year. Yeah. So there we go.
Yeah. Thanks, Moz. It's been a pleasure.
Thanks, Moz.
There we go, Money Miners. Let us know where you sit on the line. Are you long or are you short? And a massive thank you to our fantastic partners, Grounded, Sandvik Ground Support, and Cross Boundary Energy. Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.